Welcome to Lithium-ion Rocks, Season 1, Episode 12. A new star alliance is born. Alliance Minerals, Galaxy Resources, Jianxi Special Electric Motor Company. We had a good opportunity to catch up with Mark Calderwood on the immediate aftermath of his deal with Galaxy and Jianxi. But there's been a lot of news in the market and a bunch of writings that Rodney and I have done. So we also discuss his note on Albemarle's quarterly results. I comment as well on Livent and a note I wrote, Material Girl Like a Virgin, which contained an update for the Mr. Lithium Bull Market Scoreboard. We comment on LAC management changes and Ganfeng and Tianqi rights offering and other capital raises.
From a timing perspective, I think Galaxy's done extremely well buying into this. My rough valuations, depending on a number of things, but on some reasonably conservative assumptions, and we'll see if those hold, is that, in my view, and it always comes with the Surgeon General and the caveat warning of do your own research, but I'd say that a fair value would be somewhere in the region of 40 cents in 2021, so pretty much near double where it is now. So I thought it was an extremely astute move from Galaxy and from the JV partner in China, and we shall see with the confirmation of an expanded resource and reserve if there's any sort of more strategic move. I think it could become very attractive given that the very cheap capex that it would take to expand production substantially if there's demand.
Mark, our listeners may not be that familiar with Alliance, but you wrote a book and have been called Mr. Pegmatite. If you could talk about your background in lithium and how you kind of came into this project, the progress, if we can compare yourselves to Altura and Pilbara, your performance has been outstanding. Give a little bit about your background, the history of Bald Hill, and then the current status.
Okay, thanks, Howard. So my history goes back with the pegmatite, which is the hard rock source of lithium. My interest 20, 30 years ago in pegmatites was mainly towards tantalum, and when the lithium took over tantalum as the key product that people were chasing from pegmatites, I remembered Bald Hill as being a spodumene-rich pegmatite that was being mined for tantalum, and that's how we took this project quickly into production. It was the tantalum mine was on care and maintenance. We started drilling in late 2016 for lithium, first time that project had been drilled for lithium, and by the following June we had a resource, we had a PFS, and we started construction. The ore body at Bald Hill is very forgiving. It's very coarse, clean spodumene, and that enabled us to only spend $30 million on the plant, and from that we're able to produce a very nice concentrate, and the plant ramped up well beyond nameplate very quickly. So it was the plant was built by Palmiro based on the back of similar sort of ore bodies down at Catlin. That enabled us to have confidence that the plant was going to work, and we produced, a really nice product, and we still produce tantalum as a byproduct. We were able to take this production from a first resource into production in about 9 months, which is pretty unusual for a project of any type in Australia.
And how much money in total has been raised and invested to get to where you are today?
Capex, the capex was about $70 million for the project, including some pre-strip, but we're still pre-stripping as we go. We're spending free cash on pre-stripping to open up the pit, because these are fairly much flat-lying pegmatites. You really have to invest some money to pre-strip them. We've probably invested $100 million into the project, which still makes it fairly low capex compared to some of the other lithium projects that have come on in recent years.
And these are Aussie dollars, just you speak in Aussie
dollars. That's right, Aussie dollars.
Mark, there have been lots of announcements coming through from Alliance recently. Can you tell us a little bit more about the hydroxide JV and when you're hoping to finalize the terms and what those terms might look like.
Yes, Rodney. The agreement should be completed in the next 30 days or so. It's well advanced. What we have is a pretty simple joint venture. There's some free capacity in one of the trains. There's an unused train at the plant, a newly constructed plant in China, in Yishang, Jianxi plant. What we will do is feed spodumene to the plant and we'll charge the joint venture at cost. They will charge the conversion costs at cost. No capital will be included in the joint venture. Each company carries its own capital costs. We sell together, we sell the hydroxide and or carbonate. We share the margin equally. It's a pretty straightforward, very quick. We'll be in hydroxide production this year, and it'll take a while to ramp up the plant. We should see it hit its straps at the second half of next year. So it'll take 12 months from the start of commissioning to getting it up to full speed.
Could you describe your partner, Jianxi, a bit? And if I remember looking back, 2-3 years ago when you first announced him as a partner, there was Burwell in there, but Jianxi, was a little pitolite, producer. Just to describe, outside of kind of General Lithium and Ganfeng, the world of lithium is not that familiar with your partners.
Jianxi is Chinese listed non-SOE company, so it's a public company. It's got a market cap of about 2 billion Australian equivalent, so not large but not small. It's been converting lepidolite since about 2012. We're the only source of spodumene they have, and they've been converting our spodumene since about October last year. They build all the buses in Yishang, are all built by them. They do electric cars. They specialise in advanced metals too. They own a German subsidiary that makes wind farms and special electronic equipment. They also own a subsidiary in Japan, future car maker in Scandinavia. They have one plant, smaller plant, that has an LCE equivalent production rate of about 5,000 tonnes per annum. And then they just back in September, October, they built a very large, one of the biggest in the world, plant that has capability of between 30 and 40,000 tonne capacity LCE. And it's pretty much a state-of-the-art plant because it's very low emissions, because anything built in the more recent times has to be pretty squeaky clean. So it's a zero-emissions plant, essentially, and quite modernised.
When are we likely to see the ramp-up in production for the JV, and what is the availability of spodumene concentrate like from Alliance?
For the joint venture, we've predicted about 10 up to 13,000 tonne of spodumene supply. So you divide that by roughly 7. So it won't for this calendar year. It won't produce much this calendar year. A couple of thousand tonne of hydroxide. Next year, we expect it to be about 50% utilisation of the plant of its full capacity. So we'll feed about 50,000 tonne of spodumene to the joint venture. So not big numbers. It works out to about 20% of our production profile. But 2021 is a lot different. We should be able to get this up to 100 or 120,000 tonnes of feed, producing in the order of 15,000 tonne or more of hydroxide. Given our high-grade concentrates, we might be able to squeeze it closer to 20,000 tonne if we do well. So reasonably, it takes a long time. Any of these plants take a long time to get them fully commissioned. That's the nature of the beast for these conversion plants. To get them fully certified takes a long time. To get them fully ramped up, fully battery grade, certified, it takes at least 12 months, up to 18 months to get them up to full run rate. At the same time, we're still feeding the JBJ joint venture, which is the one between Burwell and Jianxi, and that takes anywhere between 100 and 140,000 tonne per year. Seller's choice, our choice of how much we feed them.
On that note, how is the company currently placed regarding offtake for the balance of the available SC6?
So we have about 80,000 tonne available over the top of those numbers for next year and this, or less for this year now, of course, because we're partway through the year. But we have about 80,000 tonne free. We're advanced discussions with a couple of parties who want that and probably want more. next year's production rate of 240,000 tonnes is as it stands now, but I think we'll be looking at ramping that up based on demand. The good thing about Bald Hill is it's an easy plant to ramp up production. It's the lowest capex DMS plant per tonne of concentrate. So it's a really, really low cost. We're doubling the plant throughput at the moment for about $16 million.
And that's all thanks to the fact that it's DMS.
It's DMS and it's forgiving metallurgy. So we get good recovery from our DMS. We probably get amongst the best recovery rates and we crush very coarse. We're actually crushing at 18 millimetres to get that good recovery. So it's just forgiving metallurgy. And there's a couple more of those potentially in the pipeline and around the world that will be a bit more like Bald Hill. But Bald Hill's the standout in Western Australia in terms of metallurgy.
Which ones in the world are you talking about?
Well, I know, I believe the Sigma one in Brazil is probably be pretty good. The Piedmont one, I believe it's probably similar. Generally, the wider the deposit, the more I tend to find them a little bit more from what I've seen, a little bit more metallurgically challenging. The narrower the pegmatites tend to be a little bit better behaved, but that's very much a generalisation.
Will the strategic placement of the 32.5 million Aussie be sufficient to grow the resource and the reserve to greater than 20 years mine life?
No, but we won't need any to raise anymore for exploration. Exploration expenditure is about $700,000 a month, so we'll spend $7 million over the next 10 months. By the end of this year, we'll be generating a fair bit of cash flow out of the plant. So it covers our capital spend requirements and our exploration spend requirements up to the end of the year. Once the upgrade happens, our costs will drop off sufficiently, and we'll be into decent cash flow.
So is the expectation that the quality of ore that will be drilled out in the exploration program will be consistent with the current mine?
Yes. So far, what we're seeing is in that new area, the Pegmatite West 3 area, that's all very coarse spodumene. Even in the eastern area, it's all pretty good, nice spodumene. So it seems to be quite coarse throughout at Bald Hill.
Alliance has got around $40 million of quite expensive debt. Do you see yourselves paying that off in the near term?
Possibly. There's a few banks starting to approach us now. If we can show a bit more track record, we're almost 1 year of commercial production now. So at the end of this quarter will be 1 year, and once we show that track record, it'll be a lot easier to get cheaper finance and look at refinancing that debt. Otherwise, we'll just pay it off, but we start paying that off by mid-next year, and it gets paid off fairly quickly based on next year's cash flow. So either we'll pay it off, we won't sit on it for long, or we'll just refinance with something that's a bit more palatable.
The announcement of the strategic equity placement had no mention of board seats attached to the largest buyer, which was Galaxy. What is your relationship with them?
So Galaxy, that's correct. There's no board seat attached to that placement. We've always often shared notes over the years. We welcome their experience in the sector. They know a fair bit. We also know a fair bit now. So and so does Jianxi. So between the lot of us, we will share notes a bit, because in this market you really need the knowledge and the customer knowledge, etc. So we get on them pretty well. We're very much like-minded. We'll be leaning on them for their experience that they can bring to the table. We certainly welcome them as a shareholder.
Assuming that spodumene concentrate prices hold and you sign another offtake partner, is Alliance now sufficiently funded that you won't need any further cash raises?
Yeah, so I'd say that's correct. We won't be looking for more equity. We have enough. This will take us through to get our capital works done. If these other off-takers offer us any prepayments, we might look at those, but I don't think equity is too palatable anymore. I think we wanted to do a decent chunk and get it dead and buried.
After this raise, how much does Galaxy own and Jianxi? Galaxy
will own 11.8%. Jianxi will own about 9%. Burwell, who are the partners that originally signed the contract with us, the Hong Kong trading house, they own about just under 6%. So really, we have two parties that have arguably blocking stakes. If someone wants to try and do something, so because we've got this, we haven't proven up our exploration potential and the resource potential. Once we do that, we don't want to be taken out before we can get some value for shareholders.
Right. So the stock, actually, I don't even have it in front of me. The market cap is what today?
About 300, I guess. Yeah, they're around 300.
Much of last year, you were kind of 50-50, and then you merged. So now investors in Alliance on either Singapore or Australia are accessing, I'm sorry, you said 300 plus million. I have a Canaccord research note which has you on 2020 EBITDA of about 100 million Aussie. I don't know if you want to comment on whether or not you think that's realistic.
Yeah, I think it's probably a little bit smaller than that, but it's next year it starts to. This year we spend everything we earn essentially, and next year the benefits start to come home to roost. So yeah, our market cap. And the reason our market cap, I believe, is low relative to our potential EBITDA cash flow next year is that it's all about resource life. We're one of the shorter mine lives of the parties out there, and that's because we really only did 1 year of drilling, and we have a lot of drilling ahead of us, and I believe we can continue to grow the resource.
And that was what I was saying earlier in this at the outset of the podcast. Whereas most companies drill, a sizable resource, they know to get to a certain size. You, with all of your experience in pegmatite, knew what was there, and even with the short mine life, just focused on kind of getting that funded and into production with the speed that you did, and now are in the process of lengthening that mine life. So I do think, mine life and the downstream strategy were the two kind of outstanding questions on Alliance, in addition to the complexity of the merger and the past ownership, et cetera. But it now seems with Galaxy, with strong Chinese partners and reasonable float out there, that as a stock, right? Everyone knows Pilbara. They know the Kidman story. They know Altura a bit. I feel Alliance is less well recognized, certainly on a North American perspective. I have a couple more questions on price as well. Canaccord has forecasted your price, I think, for this year, 776, 2020, 695, 2021, 693. These are higher prices than their average forecasted price, and presumably that's the quality differential. If you could talk about quality, has been a very underappreciated in the past, but significantly appreciated now. Dynamic, given that the pricing has fallen, but there's wide disparity based on quality. So, you talk about
it's becoming a big thing now as the margins of the converters are getting squeezed. They are now looking to the amount of fines. They don't like too much fines. They don't like too much moisture. The chemistry of the product concentrate, the amount of lithium and the iron and potassium is a nasty one if you're making hydroxide. So, and the Bald Hill is probably the best mix of everything. We've got a very coarse product. We don't have any fines in our product. We have very low water content, very low iron, very low mica, and very low potassium. So on a worldwide basis, we're probably selling the best product in the world at the moment, and we're probably getting amongst the best price too. But I think more and more, as the bigger companies come into the sector, and we're talking to some pretty big ones, they are particularly fussy about their they don't want to be spending too much money on trying to clean up for absolute premium quality hydroxide, I guess, which is where the end customer ultimately wants more and more and more. and they got to pay for the better product, I believe, particularly as the margins are tight.
Okay, great. And you mentioned I noticed your Jianxi is going to fund out of their German subsidiary. You mentioned a dynamic in the market over the last several years has been, Chinese availability of capital and capital controls, et cetera. Some companies like Tianqi managed to get $4 billion for SQM, and then other companies, have to do Hong Kong listing or are finding it difficult to raise capital. Can you comment on any of that dynamic in China?
Yes. So, yeah, it's certainly for investments, there's restrictions on the amount of money they can move around. If it's buying spodumene, it's not a problem. But, yeah, it is tight for some people, and equity placements are hard. That's why they use the German subsidiary, I believe, as a vehicle to hold the initial shareholding they have, which is about 6%. They had initially that they used that. They might use an Australian subsidiary for the next one, I believe. We also may even do some things together in Australia down the track. So it may not all be in China in the future. So there's been a few loose discussions around that point as well.
Could you discuss that? I mean, the evolution of this space, right? Today, as we sit here today, 100% of the world's conversion capacity is in China. A number of converters are being built in Australia, and Quebec is a different story. But how do you see this evolving? This carbonate, this hydroxide. You had mentioned something about an interim kind of sulfate ideas. If you could just talk a little bit about how you see the market.
Yeah, we're doing a bit of scoping work at the moment, and it seems that, Western Australia will have arguably the 2 or maybe 3 biggest hydroxide plants in the world will be in WA. Some of our customers, potential customers, have expressed interest in lithium sulfate or something similar. So an intermediate product, and the advantage of that is you don't have to worry about the hydroxide shelf life. It enables them to take it to Japan or Korea or China and actually and dissolve it and take it up to hydroxide that they need, quality that they actually want for their particular battery or whatever other chemistry they want to make. And it's a lot easier for us because we don't have to worry about getting rid of any nasty potassium sulfates or sodium sulfates or any other those chemicals which you can sell in Asia fairly easily. You sell it into the market, but in Australia we're a fair way from that market. So we're looking at maybe thinking a little bit out of the box and ask the customers what they're after, and rather than try and make battery grade hydroxide ourselves, try and compete with those bigger guys that are doing it, we might be looking for something a little bit more niche.
What's the price of lithium sulfate?
That'll be the devil of the details. So we have to find out what the variability will be between a clean one and maybe one that's carrying a little bit of chemistry in it. It's too early to tell yet what the pricing is and whether that's economic, but with the increasing difficulties of environmental approvals in places like China and Korea, it's certainly and space and land issues in those places, expensive land and distant from the port. They are fairly attracted to someone that can take it part of the way for them.
How should we be looking at Alliance? I think you said 300,000 tons of spodumene by 2021.
Initially, it's 240,000 tons next year, so 20,000 ton a month. If the customers want 2021 increases for 2021, then we'll look at taking it beyond 240 to the next logical step, which is 300 or 360,000.
And of that 240,000, how much of spodumene is connected to the hydroxide joint venture?
Next year, it only represents about 25-30% of our production. Early 2021, we should be going up to about 40% would be hydroxide.
What is your, offtake pricing mechanism?
At the start of this year, we shifted from the fixed price to a formula-based pricing. The formula that we currently use is the carbonate one, but we will have a mixture of hydroxide and carbonate going forward. We're in the mid-sevens. We're over mid-sevens last quarter. This quarter we should be around close to the mid-sevens. It's not a bad pricing, but it will change with carbonate and hydroxide pricing quarterly basis as we go forward.
And what are your all-in costs?
For the last quarter, I think it was about $585 cash. That's without counting the royalty. So even though we get mid-700s on the royalty, we lose 5% royalty in Western Australia to the government. But so our cash costs low to mid-fives this year, US, and going down to the low fours next year.
The Galaxy management team are actually quite good deal makers and creators of shareholder value. One mid-tier, joining another mid-tier. There's a lot of skill sharing that came through in the interview with Mark Calderwood. Everybody talks, in Western Australia. They both use Primero, right? So there are synergies there. So I just think this is an astute move by Galaxy. Mark Calderwood Alliance had an unusual path to production. Successful. If you look at the ramp-ups between Pilbara and Altura and the quality of the product and the price that Alliance is getting, hats off to them. I have not been a fan of Alliance for a large amount of time over the last kind of 3 years, but I put them very much on watch list because of their downstream hydroxide plan, their good partnership now, and the high likelihood of resource expansion.
I did a review, I put it up on Seeking Alpha on Albemarle's first quarter of 2019 lithium segment results. And their net sales were down 2%, but they had warned about a production disruption with rains in the Salar de Atacama and some qualification delays at Xinyu 2 and currency movements. But overall, I think one would have to acknowledge that their long-term offtake contracts have saved the day as far as EBITDA margins and pricing for their carbonate and hydroxide production. Some of the key things that they mentioned that I thought were really important is China, industrial-grade carbonate prices are at break-even levels for non-integrated, independent converters, and that reconfirms what Livent said. More importantly, they said, Wodgina spodumene concentrate, which they have an interim marketing, rights to, even though the deal is not finalized. They said they wouldn't sell that material indiscriminately into the market if demand wasn't supportive. So fears of further spodumene concentrate coming out into the market have been alleviated to some extent. Talked about a shift in production of 3,500 tons to later quarters. But with that said, they made a separate statement, and again, same as Livent, talking about brine production volumes from all of South America, all the projects as a whole likely to be flat in 2019. So again, further evidence of brines being at the heart of the oversupply, myth, being dispelled again. They talked about lithium yields program in the Atacama, increasing production by 30%, targeting second half of 2021, and that's without pumping extra brine. We'll wait to see if that comes through. The Kemerton plants on track, and the Greenbushes expansion. But if you look at the pricing metrics and what Albemarle needs as long-term lithium hydroxide prices to justify the Wodgina investment of what's likely to be $2 billion for 50,000 tons of nameplate capacity, and clearly effective capacity will be lower than that, is $14,000 a ton plus.
Livent had really bad results, and what was reflected in that, in my mind, was Livent had kind of talked about, they had 80% of their contracts, also fixed for this year. So I was very surprised that their commentary about their customers in Korea and Japan on the hydroxide side were just not, taking the product now, whereas Albemarle's were. And it just reflected that Albemarle just seems to have better customers, right, or more reliable customers. There were some management changes at Livent following that result, so something clearly is not as rosy or clear cut as advertised in the IPO. The stock is nearly a 1 billion market cap. It's halved since its IPO. One thing I'd like to point out is Paul Graves made a sustainability argument of Volkswagen and the hard rock sustainability, and he basically said he disagrees with their thesis. I guess he's talking his own book, but advantages of brine-based source of lithium carbonate is that it has a smaller carbon footprint. In his opinion, much of the energy we use is renewable, solar and wind, evaporation. There's merit to that argument, and we've been talking, this is not just going to be all brine or all hard rock all the time. The market needs both. There's been a lot of noise, negative noise about Chile last year. I think that there's room here potentially for some positive focus, and in particular the Maricunga asset, what's happening with lithium power. And that's a very advanced project. It's very high grade. It's at full definitive feasibility study. Chile, from a risk point of view, I think looks a lot less risky than Argentina. So that's just one story that I think has been under the radar that investors will take a bit more notice of in the coming weeks and months. Our growth plan is basically $600 million to grow carbonate from 20,000 tons to 60,000 tons. So a 40,000 increase for $600 million is equivalent to $15,000 capital intensity per ton. To have the lowest cost carbonate in the world, he thinks that that's a very competitive and compelling investment case. And I don't disagree. If he could achieve that, they could achieve that, then that is a very good outcome. It makes me question, though, all of the pre-feasibility studies in Argentina and other companies that are, suggesting that they could do it also for $15,000 a ton, right? Or like how could a greenfield in Argentina, be less expensive per ton, than the most experienced company, one of the most experienced companies in the industry, doing a brownfield expansion. So I would just look, with caution. That we might have some cost increases from PFS or even DFS level Argentine brine stories.
In fairness, is sometimes you just can't get the firm pricing till D-Day, but that's fair, Howard. I think when D-Day comes, we'll have to do a reassessment.
When I was looking at Lithium Americas with the resignation of Tom Hodgson and the appointment of John Evans, I guess congratulations to both of them, but even within their quarterly report, they're talking about, okay, they are seeking, bids now, right, for long lead time items. Even when companies say that they're fully funded, it's only now that they're spending, real dollars in Argentina. I've been very close with Lithium Americas over the years and had worked directly with Tom Hodgson. So I just did a quick take. The merger between Western Lithium and Lithium Americas happened, I think, in July of 2015. So about 4 years since that was announced, and I think 3.5 years where Tom was actually the CEO. And over that time frame, basically Lithium Americas stock has doubled. Right, so 100% up in 4 years, which is not bad. I compared it in my most recent Lithium Bull, though, to some hard rock stories like Kidman and Pilbara. Perhaps unfair, but those stocks were up 7 times and 21 times. So it speaks, and if I could speak a little bit about this short note I wrote called "Material Girl," like a virgin. We've gone through various iterations: Lithium 1.0 in 2009-10, Lithium 2.0 in 2016-17, and I think we're setting the stage for a Lithium 3.0. And I believe there's been a lot of learnings, and but also that companies that have developed projects in the last couple of years that are currently unpartnered I guess call them like a Virgin, are likely to get better deals than, their lithium 2.0 or in some cases, lithium 1.0 brethren. I keep coming back to the keep it simple, stupid, grade matters, technical risk matters, management, sovereign risk, and then Albemarle's, spider web of factors. And then I added my own for a Jane and George battery pack kind of checklist. If you have a project that's 20,000 tons a year, for 20 years, preferably hydroxide, but carbonate also okay. It's going to cost 500 to 600 million capex, again, similar to what Livent is suggesting. Proven conventional technology, mining-friendly jurisdiction, tax-friendly jurisdiction, predictable jurisdiction, with a 10 to 20-year view. And if you could be fully ramped into this kind of 2023, 2024 forecasted shortfall, and I completely agree with you, the prices should be $14,000, $15,000. The real question in my mind is who is actually going to get in production, and can they produce at 6,000 or 5,000, cost? And if you can, very significant margins. Finding non-Chinese assets for non-Chinese demand, with good management, skin in the game. These are attributes that I think are very important, and there's a number of companies on the Mr. Market Scoreboard that we talk about, that we write about. That's where I'm focused a great deal of my time as an investor, is the spectacular returns that are available, for projects that kind of meet this criteria, that could have a Kidman-like, West Farmers event, or a Mineral Resources, Wodgina, Albemarle event. Once sentiment returns in a broad way, which it will, to the lithium space, the leadership will happen in Albemarle. But if you look at the Mr. Market Scoreboard, there's a number of stocks that were up, 50 to 80%, year to date. For a Jane and Joe battery pack who doesn't need a huge amount of liquidity, stock picking has been very good so far year to date, and I think that will continue in this lithium 3.0. I think it will still be stock selective, and it's very important to...
Absolutely, Howard. I mean, if you look at the perils and the difficulties of producing a battery grade and OEM qualified hydroxide or carbonate for that matter, it's a hurdle that not all are going to meet.
Ganfeng and Tianqi, we'll talk about briefly, are both in market. Tianqi did an interview with Henry Sanderson at the FT, kind of talking about market bottoming, or it'll stabilize. At the same time, they're in market with a $1 billion deleveraging exercise in the Shenzhen listed share. They couldn't get the Hong Kong listed share off. So the Tianqi share, if you look at the Ganfeng share versus the Hong Kong share, there's still a very wide discrepancy. But here, Tianqi is going to raise money at probably a relatively inflated price on Shenzhen. They've obviously had government support to give them $4 billion in debt. But the institutions in China which own Tianqi, I suspect that there's some government involvement in there as well. But anyway, they're deleveraging. They're in market. We could talk about Tianqi, but most people listening to this actually can't invest in Tianqi. Ganfeng is doing both a convertible bond locally, and they're also doing, I think it's a rights issue in Hong Kong. The Shaoshen and Mr. Li are participating in both, so skin in the game there is good. I mentioned they're disproportionately investing in the much cheaper priced equity in Hong Kong than in the convertible in China, but I guess that's their prerogative. That stock is cheap, and similar to Albemarle, they have high volume converting, carbonate and hydroxide, and the proven record of battery grade. So our story, both of us have been supportive of Ganfeng, but we knew this past quarter and Q4 were unlikely to be, very good. But with spodumene prices a bit lower and with their ramp-ups of their volumes, the second half and into next year, I think we might start seeing some good things from Ganfeng. With that, I think we can sign off on another good podcast, Rodney, and we're getting ready, both of us, to kind of come to Chile in the next kind of couple of weeks, but I'm sure there'll be lots of other news between now and then, including SQM's results this week, and we'll be commenting on that. Please look out for us on LinkedIn, Seeking Alpha, and very, very, very importantly, the Lithium-ion Rocks is now on iTunes and Spotify and Podbean and Stitcher. It took a long time. We were on a lot of those, but the iTunes, we had some sort of coding glitch that took a little bit longer for us to get there. But I'd still encourage all of you to listen on SoundCloud to get the full effect of the Lithium-ion Rocks, and you'll know what I mean if you listen to the SoundCloud versus one of the other venues. But we do know that many of you prefer those others, so looking forward to broadening the reach of Lithium-ion Rocks and what I call lithium equity intelligence. In Lithium-ion Rocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other Lithium-ion Rocks or Lithium-ion Bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.